Welcome back to the Deep Dive. Today, we are strapping ourselves into the cockpit of a defense contractor that, frankly, refuses to act like one. We are putting Kratos Defense and Security Solutions, ticker symbol KTOS, under the microscope. We're analyzing a company that deliberately positions itself not just as, a manufacturer of jets and satellites, but as a technology disruptor working at, well, Silicon Valley speed.
That framing is critical, yeah, because it really highlights the core paradox here. When you think of a big defense prime contractor, you picture these decades-long program cycles, massive financial weight, political inertia, bureaucracy,
Right.
the whole 9 yards.
Right, the establishment.
Exactly. Kratos, though, they've consciously modeled their operations more like a venture capital-backed outfit. It's all about agile engineering, speed to market.
So our mission today is to really get under the hood, understand the DNA of this disruption.
Precisely. We need to analyze its unique dual business model, which is fascinating in itself. And ultimately, we have to figure out if this high-octane, cash-burning approach is actually sustainable, especially when you look at the, frankly, staggering price the market is putting on its future potential right now.
And the market is demanding a massive premium, no question. But before we get into those financial extremes, let's just unpack their basic strategic identity. The core idea, the thesis that guides their whole strategy, it seems pretty simple. They win by being cheaper and faster than everyone else.
And that's where their defining company philosophy comes in. Kratos states it explicitly. Affordability is a technology.
Okay, affordability is a technology. That's catchy, but what does it actually mean in practice?
Well, it's not just marketing fluff. It genuinely guides their design choices, their engineering. They are not trying to build the single most exquisite, gold-plated, technologically advanced system on the planet.
That's the job of the Lockheeds and Northrop Grummans, the tier ones.
Exactly. Kratos prioritizes what they call leading-edge technology. That means proven, reliable tech that's ready to integrate quickly. They deliberately avoid chasing the bleeding-edge concepts, the stuff that drags traditional defense programs into those multi-decade development cycles and ends up with massive cost overruns.
Ah, okay. So their disruptive edge is basically de-risking the whole development process for the customer. We're saying, we can give you the capability you need now without the crushing technical risk, the schedule risk, the financial risk that usually comes with buying defense gear.
Precisely. They seem to have cracked the code on how to get functional products fielded in, well, months, not decades. And that speed, in today's geopolitical climate, that speed itself is a massive strategic asset. Okay.
So for this deep dive, what are we working with? What sources?
We're drawing on a really in-depth investment analysis. It covers everything from Kratos' unique operations, the shifting market dynamics, right through to their pretty complex financial performance, looking out through about mid-2025. And crucially, it dives into the major risk factors, the things that will determine if they succeed or, stumble. This is really about understanding how the future of warfare itself is being funded.
Right, and to understand that funding, that strategy, you first have to grasp that Kratos isn't really one company, is it?
That's the key insight. You absolutely have to recognize that the company functions as two pretty distinct entities, operating under one corporate roof. This dual business model, it's the entire engine that funds the disruption they're aiming for.
Okay, let's unpack this then. If Kratos is basically two companies in one trench coat, we need to understand what each part does. Because, like you said, one seems to be the bedrock, the stability, and the other is the high-risk, high-reward bet on what's next.
That's exactly right. So we look at their two main reporting segments. First, there's Kratos Government Solutions, or KGS. Then there's the Unmanned Systems segment, which they just call US.
Okay, KGS first. The stable part.
KGS is the steady foundation. It's the profit engine. It's a deeply entrenched business that provides the financial stability, the current operating income, and it's essentially subsidizing all those massive, cash-intensive R&D efforts happening over on the unmanned side.
So KGS provides the cash to feed the drone monster, so to speak.
Pretty much, yeah.
What exactly falls under KGS, and why is it so stable? What makes it the bedrock?
Well, KGS is actually a highly diversified portfolio. It's got established, often mission-critical businesses within it. The real cornerstone, though, is their space, satellite, and cyber unit. Kratos is genuinely a global leader here.
In what specifically? Satellite comms?
Primarily in satellite ground systems, especially things like virtualized architectures and command and control software, C2 software. And this shift to virtualization, it's a huge deal in the space industry.
Yeah, so.
It means customers can move away from relying on really expensive, fixed proprietary hardware that has to sit in remote, often vulnerable locations. Instead, they can use software-defined networks. These are cheaper, they're more resilient, easier to upgrade, much more scalable.
So that virtualization, it plays right back into their core. Affordability is a technology theme, even up in space.
Absolutely. And what's really remarkable, honestly, is their market penetration. Their tech supports something like 80% of all U.S. space missions. 80%.
Wow, 80, that's dominant.
It is. That level of deeply entrenched market position, it gives KGS phenomenal stability. And think about the switching costs for the customer. They're huge. So it's just an invaluable, reliable cash flow generator for the whole company.
And KGS isn't just, sitting back and collecting checks. They're still winning new big contracts that prove they're agile in this space, too.
Yeah, definitely not resting on their laurels. Look at the recent $116.7 million prime contract they won. It's for the Space Development Agency's, the SDA's Advanced Fire Control Ground Integration System, AFCGI, they call it.
Okay, and what's significant about that win?
Well, the dollar amount is nice, obviously, but the key performance indicator here wasn't the money, it was the speed. Kratos completed the preliminary design review, the PDR, for that really complex system in just 5 months. 5.
That's fast for government work, especially space systems.
Incredibly fast. And it accelerates the timeline for the entire SDA constellation, which is critical for national security. It proves their fast-track methodology works even on highly technical, vital infrastructure projects. It validates the model.
Okay, so beyond the satellite ground systems, what else is in this stable KGS bucket?
KGS also includes 2 other really high-value components. First, there's microwave electronics and digital solutions. Think critical components, hardware, software that go into high-performance military platforms. Stuff like missiles, satellites, advanced radar, electronic warfare systems.
So the guts of bigger systems sold by the primes.
Often, yes, they're essential subsystems. Second, KGS covers C5ISR systems. That's command, control, communications, computers, cyber intelligence, surveillance, and reconnaissance. And, importantly, hypersonics also falls under KGS.
Hypersonics is a huge national priority right now. What's Kratos' specific angle there? Are they building the missiles?
We're working on some high-priority platforms, yeah, things like Irenaeus and Dark Fury. But maybe more crucially, right now, Kratos is deeply involved in providing target support services for hypersonics.
Ah, so they build the things the hypersonic weapons shoot at.
Exactly. To test a brand new hypersonic weapon effectively, you need an accurate, realistic target vehicle to measure its performance against. Kratos provides these targets, and that gives them an early, really intimate view into the developmental pipelines of the U.S. military's most advanced offensive programs. It's a strategic position. So KGS is basically this mature, high-value provider of specialized tech services and components. It's the reliable engine.
Okay, now we cross the internal company divide to segment 2. Unmanned systems, or US. This is the segment that grabs the headlines, the drones, the Valkyries.
Mm-hmm.
It's the growth engine driving that crazy valuation, right? But it's also the part that's currently, losing money for the company.
That's the strategic gamble in a nutshell. The U.S. segment is the primary vector for that disruptive growth Kratos talks about. It's the public face of their strategy. And it really has 2 main pillars within it.
Okay, what are they?
The foundational one, believe it or not, is their target drones business. Kratos is actually the leading global provider of these high-performance, threat-representative aerial targets. We're talking platforms like the BQM-167A, the BQM-177A, really sophisticated stuff.
And these targets, they're designed to mimic advanced enemy threats, like cruise missiles or fighter jets.
Precisely, but the business model there, it's kind of genius, isn't it?
Well, it generates recurring revenue, which is always nice.
It's crucial recurring revenue because these aren't assets that just sit in a gathering dust. They are specifically designed, intended to be shot down. They get expended during training exercises, weapons testing, system evaluations.
They have to be constantly replaced.
Exactly. That provides a remarkably stable, almost non-cyclical revenue stream, even within the U.S. segment itself. It actually helps reduce the overall volatility of their big R&D bets.
Okay, but the real focus, the exponential growth potential that gets investors excited, that lies with the tactical drones, right? The UCAVs.
Exactly. The unmanned combat aerial vehicles. This is the flagship growth category. We're talking about affordable, reusable, jet-powered combat aerial vehicles designed explicitly as force multipliers for manned fighters.
And the XQ-58A Valkyrie is the star of that show.
It's definitely the headliner. High subsonic speed, runway-independent launch, very capable. But we also need to include platforms like the UTEP-22 Mako and the Airwolf Tactical Firejet. These systems are absolutely central to the Pentagon's whole vision for distributed, autonomous, and eventually, attritable warfare.
Okay, now let's zero in on that financial split again. You mentioned it earlier, but let's detail the numbers for the first half of 2025, because you said it's the clearest evidence of the strategic choice management is made here.
The numbers are stark, and they're completely intentional. So for the first 6 months of 2025, KTOS, the stable, profitable segment, it generated a combined operating income of $34.3 million. That's the engine running smoothly, generating cash.
Okay, $34.3 million in profit from KGS. And the high-growth, high-potential U.S. segment, the drones and targets, what did that cost Kratos over the same 6 months?
The unmanned systems segment posted a combined operating loss of $2.0 million over that same period.
Wow. So a profit of over $34 million from one side and a loss of $2 million from the other.
Yeah. That roughly $36 million disparity between the two operating segments, it confirms the entire strategy right there. The cash-rich KGS segment is actively, deliberately financing the cash-intensive, future-focused R&D gamble on these unmanned combat platforms. It's basically a strategic subsidy. The stability of the established services is paying for the disruption in next-gen hardware.
That raises a really interesting question about managing a company, doesn't it? How challenging is it to run two such fundamentally different corporate cultures under one roof? I mean, one side is focused on stable, high-margin, predictable service contracts, long timelines. The other side is all about rapid prototyping, high-risk development, fail fast, and accepting operating losses for potentially years.
Yeah.
How do you manage that?
It's got to be an enormous managerial challenge, no doubt about it. The steady, disciplined pace you need for C5ISR sustainment or for maintaining 80% of U.S. space ground systems, that's just radically different from the agile, maybe even chaotic ethos you need in a drone development program.
Right, different skills, different metrics, different mindsets.
Totally. Success really hinges on the leadership, particularly CEO Eric DeMarco, being able to keep the KGS team focused on execution, hitting their numbers, generating that cash, while simultaneously giving the U.S. segment the financial freedom and, crucially, the cultural space it needs to innovate, to take risks without suffocating them with constant pressure for short-term profit. That $36 million gap we talk about, that's not just a financial number. It's the cost of maintaining two distinct, necessary cultures within the same company. It's a strategic investment in organizational design.
Okay, this is where it gets really interesting for me. Why now? Why is the market for these specific types of products affordable, attritable, unmanned? Why is it exploding right now? It almost seems like Kratos, whether by luck or design, positioned itself perfectly for this massive generational shift in geopolitics and military thinking.
Well, I don't think it was entirely luck. They definitely anticipated the fundamental shift that was coming. Look, for 2 decades, maybe more, the entire U.S. defense apparatus, its budget, its structure, was optimized for counterterrorism, counterinsurgency operations. HUA-9.
Right, Afghanistan, Iraq.
Right.
Fighting non-state actors.
Exactly. Now, the pivot is fully, unequivocally on. It's all about near-peer competition. Strategic competition against technologically sophisticated state adversaries, primarily China and Russia.
And this massive strategic pivot, it fundamentally changes everything about how the Pentagon thinks, plans, and most importantly, spends money.
Absolutely. It triggers what Kratos management, I think, quite rightly, terms a generational recapitalization of strategic weapon systems. You're seeing budgets move quite dramatically, actually, away from expensive legacy hardware, platforms designed back in the 70s and 80s. And that money is flowing directly towards next-generation capabilities, things like autonomy, resilient space systems, advanced cyber defenses, hypersonics.
And Kratos is playing right in the middle of almost all of those priority areas.
They're positioned squarely in the deep end of every single one of those key priorities. It's remarkable alignment.
And this doctrinal shift, this focus on near-peer conflict, has given rise to these new buzzwords, or maybe core concepts: mass and attritability. And these terms sound like they could have been coined specifically just to describe Kratos' product line.
They are arguably the single biggest driver of demand for what Kratos builds. It's fundamental. Recent high-intensity conflicts, extensive wargaming exercises, they all highlight that in a fight against a peer adversary, the U.S. military requires mass. That means the ability to field a massive quantity of systems, to overwhelm sophisticated defenses, to saturate the battle space.
You can't do that with multi-billion-dollar aircraft carriers or $100 million fighter jets alone. You need numbers.
Exactly, and that's where a tradable comes in. It's the key operating concept enabling mass. A tradable means systems that are either fully expendable, designed to be used once, or reusable but with an acceptable low loss rate. Think about that $2 million Valkyrie we mentioned. Losing one is regrettable, but it's not a strategic disaster.
Let's just pause on that point for a second, because for decades, the military mantra, especially for air forces, was never intentionally lose a platform, especially not a jet. This shift towards embracing attritability, the idea of planning to lose combat assets, even small jets, that's a profound cultural change within the military, isn't it?
It's a massive shift in strategic calculus. The underlying concept is that the loss of, say, a $2 million Valkyrie, or maybe even a sub-$1 million drone, is simply an acceptable strategic cost to achieve a specific mission objective. It's factored in. But if you lose a $100 million manned F-35 plus the pilot, that's a catastrophic failure strategically, financially, politically. It's unacceptable. Kratos' systems are designed from the ground up from day one to be affordable and plentiful enough that you can accept losing some of them. That's the point.
And the most prominent sort of public manifestation of this whole strategic pivot, the thing that aligns perfectly with Kratos' affordability model, is the Pentagon's Replicator initiative.
Yeah, Replicator is basically the blueprint for how the DoD wants to fight in the future, or at least a big part of it. The initiative aims to rapidly field literally thousands of small, cheap autonomous drones and other systems across all domains, air, sea, land, to counter the large-scale military advantages, particularly in terms of sheer numbers, held by adversaries like China.
And Kratos, with its history of quickly producing low-cost jet targets and now UCAVs, they seem tailor-made for this.
Their entire company history, their established capability to produce affordable jet-powered targets and UCAVs quickly, it makes them a natural fit for this kind of large-scale mass production mandate. Replicator is playing directly to their strengths.
Let's look at the sheer scale of investment going into this area. What do the budget numbers tell us about the DoD's actual commitment to unmanned systems and AI? Is it real money?
Oh, it's very real money. The investment is surging, and it looks generational in scope, honestly. The DoD's budget for fiscal year 2024, for instance, included roughly $10.95 billion specifically earmarked just for uncrewed vehicles. That's just 1 year.
Nearly $11 billion, just for unmanned.
Yeah. But the real crown jewel, the program everyone is watching, is the U.S. Air Force's Collaborative Combat Aircraft Program, CCA.
Right, the loyal wingman concept. Autonomous drones flying alongside manned fighters.
Exactly. That CCA program, it has a projected budget of somewhere around $28 billion just through 2029.
$28 billion. Okay,
Yeah.
That's not niche funding anymore. That's serious money defining the next couple of decades of air combat.
Absolutely. And you have to understand, these CCA platforms, they're fundamentally different from the traditional drones we might think of, the remotely piloted Predators or Reapers. These new systems rely heavily, critically, on artificial intelligence and edge computing.
Edge computing, meaning the processing happens on the drone itself.
Precisely. The modern battlefield generates just unbelievable amounts of sensor data, petabytes of it. For these drones to make decisions in real time, especially if communication links are jammed or severed, they must process that data on board, right there at the edge of the network. They'll use AI algorithms to make autonomous choices, targeting, maneuvering, coordinating with other drones, minimizing reliance on vulnerable central communication links back to a human operator miles away.
So Kratos isn't just building cheap and fast airframes. The hardware itself has to be sophisticated enough, powerful enough to be AI ready, to handle that intense computational load right there on the platform.
Exactly. You can think of the hardware, the airframe, as almost just the chassis. The real value, the real capability lies in the software, the sensors, and the autonomy packages. Kratos has to ensure its airframes, its internal power and data architectures can seamlessly integrate with and support these cutting-edge AI and machine learning packages that the Pentagon and its partners are developing. It's a systems integration challenge as much as a hardware one.
Okay, let's broaden the view slightly. Look at the overall market tailwinds. The sheer size of global military spending must provide a huge underlying opportunity.
The trend is just unambiguously towards rapid expansion everywhere. Global military spending hit a record $2.4 trillion in 2023. Trillion with a T.
2.4 trillion. That's staggering.
It is. And if you focus down on Kratos' specific domain, the military drone market alone is forecast to grow from about $15.8 billion in 2025 to over $22.8 billion by 2030. That's a healthy compound annual growth rate, CAGR, of about 7.6%.
Okay, nearly 23 billion just for military drones by 2030.
And if you look even broader at the entire unmanned systems market, air, ground, sea, the whole ecosystem, that projection hit something like $43.5 billion by 2030. That's an 8.2% CAGR. The growth is undeniable.
And you mentioned earlier that the way contracts are awarded is also shifting in Kratos' favor. Let's revisit the importance of LPTA.
Right, LPTA. Low price, technically acceptable. This shift in procurement criteria, particularly for certain types of systems, is a huge strategic advantage for a company like Kratos. It actively bypasses the core strength of the legacy prime contractors, which is their ability to deliver incredibly complex, exquisite, high-performance systems, but often at the cost of speed and, well, high price tags.
So LPTA basically says, if you meet the minimum technical requirements and you're the cheapest, you win.
Essentially, yes. It mandates that if a contractor can deliver a compliant solution quickly and cost-effectively, they often win the bid, even over potentially more sophisticated but more expensive and slower alternatives from the big primes. Kratos' entire design philosophy, that affordability is a technology mantra, is engineered specifically to win these LPTA competitions. The market structure itself is increasingly rewarding speed and affordability, playing right into their hands.
Okay, so the market opportunity is clearly massive, and the trends seem perfectly aligned with Kratos' strategy. But how does a relatively small company like Kratos actually survive, let alone thrive, when they're swimming in a tank full of sharks? I mean, the defense giants like Lockheed, Boeing, Northrop Grumman, RTX, they have infinitely greater scale, resources, political clout.
Yeah, understanding how they compete, how they've carved out a defensible space is the real key to the Kratos story.
We know the competitive landscape is brutal. The Tier 1 primes are obviously formidable. Sometimes they're partners or subcontractors to Kratos, which is interesting.
Right, it's a complex relationship, co-opetition.
But they're also direct competitors. And you mentioned Boeing's MQ-28 Ghost Bat specifically. That's gunning directly for the same attritable wingman market as the Valkyrie, isn't it?
It absolutely is, and Boeing has massive resources behind it. Plus, you've got mid-tier rivals, too, like AeroVironment and smaller drones. Textron has a growing unmanned portfolio. It's crowded.
So what's Kratos' edge? What's their competitive moat, assuming they have one?
Well, the critical insight, I think, is that Kratos has successfully carved out a specific, defensible economic moat. They don't even try to compete head-on based on scale or political influence. They'd lose that fight every time. They compete on operational velocity and, crucially, on culture.
Okay, operational velocity and culture. Let's break that down. What's the first element of this moat? You mentioned their first mover advantage earlier.
Yes, specifically their first mover advantage in attritable jet platforms. This is huge. Why is that specific lead so important? It comes down to data and experience.
How so?
Well, think about it. Since around 2020, Kratos has actually flown 4 distinct jet platforms in this specific class. The Valkyrie, the Mako, the Airwolf. Plus, they were the prime contractor for DARPA's Gremlins program drone.
Right, 4 different jet drone programs flying.
Exactly. That means they have accumulated years of invaluable real-world flight data. They've tackled the systems integration challenges. They've built deep operational relationships with the customers using these things. Any new entrant, even a giant prime contractor starting from scratch on an attritable jet drone, will struggle mightily to match that accumulated experience base quickly. Kratos is simply years ahead on the learning curve for this specific niche.
And that track record, that ability to get 4 jets flying, speaks directly to the company's speed and agility, that disruptive culture you mentioned, allowing them to operate on startup timelines.
It's genuinely phenomenal when you compare it to the traditional defense acquisition cycle. Consider the Valkyrie again. Contract award to first flight in just 2.5 years, 2.5 years.
Which, for brand new jet-powered military aircraft, is.
It's virtually unheard of in the traditional defense aerospace sector. It just doesn't happen. Kratos seems culturally wired from the top down to meet the DoD's growing demand for rapid capability fielding. Speed is their weapon.
And this agility, this speed, it links right back to that design for affordability concept we talked about. It's not just a goal, it's baked into their whole engineering process from day one.
That's really their core competency, I'd argue. Kratos engineers its products upfront specifically for rapid, large quantity, low-cost manufacturing. They use things like modular designs, less exotic materials where possible, commercial off-the-shelf components when suitable. It's all about ease of production at scale.
Which contrasts sharply with how the big primes usually operate.
Very sharply. The prime's cultural default, often driven by performance requirements, is designing for maximum capability, maximum performance, usually in relatively small quantities. This leads to highly complex, very expensive, exquisite systems built in small batches. Think F-22 B-2 bomber. Incredible machines, but incredibly expensive and produced in tiny numbers. The primes would actually struggle culturally and logistically to pivot their massive, complex manufacturing base to suddenly start churning out thousands of cheap, simple drones per year. It's just not what they're built for.
But Kratos made an even shrewder strategic move, arguably, than just efficient design. They vertically integrated a really key component. Let's talk about that TDI acquisition.
Yes, the 2020 acquisition of Technical Directions, Inc., or TDI. That was a defensive masterstroke, frankly, and it provides a crucial competitive advantage. TDI makes a portfolio of high-performance small turbojet engines, the kind you need for these target drones and UCAVs.
So they bought their engine supplier.
Essentially, yes. By owning the propulsion system, literally the beating heart of the UCAV Kratos gains several vital advantages. They get much tighter control over their supply chain for the most critical component. They can ensure better integration between the airframe and the engine. And maybe most importantly, it protects their intellectual property in an area small, affordable jet engines that is a key bottleneck for the entire industry right now. They are not dependent on an outside supplier who might also sell to competitors for the single most critical power component. That's huge.
Okay, so they have speed, they have experience, they design for cost, and they control their engines. That sounds like a strong moat. However, every growth story, especially one challenging incumbents, comes with structural disadvantages and risks. Kratos still has to operate in the shadow of these giants.
Absolutely. The scale problem is unavoidable, and it's their primary competitive disadvantage. Full stop. Kratos simply lacks the vast financial strength, the established global supply chain leverage, the sheer manufacturing capacity, and frankly, the political weight that the Tier 1 primes possess.
And that focus on low price, while great for winning contracts, must put constant pressure on their profit margins.
It creates inherent and persistent margin pressure. That's the trade-off. And this margin pressure has been significantly exacerbated recently by the fact that many of their earlier development contracts or the initial production ramp-up deals were signed as fixed-price contracts before the big spikes in global inflation hit materials, labor, everything. So they're locked into prices that are now much tighter than anticipated.
Ouch. Okay, and then there's what you call the crucial transition risk. Kratos seems like a champion of the R&D phase, the rapid prototyping. But what happens when the military decides, okay, we love the Valkyrie, now we want 3,000 of them. Can Kratos actually deliver that scale?
That is the central long-term risk that every single investor in Kratos is weighing right now. It's the billion-dollar question. Kratos' competitive edge is clearly strongest in that initial innovative R&D phase, getting prototypes flying fast, the disruptor phase. However, if programs like the collaborative combat aircraft mature, as expected, into massive, sustained, high-rate production efforts procuring potentially thousands of systems annually over many years, then the sheer scale, the global supply chain management expertise, the manufacturing efficiency, the quality control at volume, the logistics support, all the things the primes excel at, those become the decisive factors.
So the risk is that Kratos wins the design competition, proves the concept,
but then gets marginalized when it comes to the massive manufacturing marathon.
Yeah.
The risk is that Kratos is either forced to become a junior partner or subcontractor to a prime to meet the volume, thereby losing the high-end profitability and control. Or they're simply pushed aside because they physically cannot scale their own production fast enough or efficiently enough to meet the required delivery schedules and cost targets at massive volume. They might invent the future, but someone else profits from building it at scale.
Okay, that makes sense. So what is this whole picture, the dual business, the market alignment, the moat, the risks? What does it all mean for the actual balance sheet? Because when you look at Kratos' financial profile, it is genuinely confusing. Like we said at the start, it looks far more like a high-growth, capital-consuming tech startup than a traditional, stable defense contractor.
That is the financial paradox we absolutely have to dissect. First, let's cover the good news. The top-line growth, the revenue momentum is undeniable. It's strong. Revenues grew pretty impressively from $618 million back in 2018 to $1.136 billion in 2024.
Okay, so nearly doubling in 6 years.
Yeah, that represents a robust compound annual growth rate, CAGR, of about 10.7%. Not bad at all. And even more recently, that growth has actually picked up steam. It's accelerated. Q1 2025 revenue was up 19.6% year over year. Q2 2025 was up 17.1%. The demand signal from the market is flashing bright green. Customers want what they're selling.
Okay, strong revenue growth. That usually correlates with stellar profitability in most industries. But that's clearly where the Kratos strategy diverges, isn't it?
Completely. Profitability is being intentionally, strategically suppressed by massive investment. That's the core trade-off. While their gross margins are actually pretty stable and healthy, they hover around 25–26%,
Yeah.
thanks primarily to that profitable KGS services segment. The operating margins are razor thin, extremely thin.
Okay.
In 2024, the consolidated operating margin was just 2.6%, and in this second quarter of 2025, it was even lower, just 1.1%.
1.1% operating margin on over $1 billion in revenue. Wow.
Yeah. And that suppression is the direct visible cost of the disruption strategy. Every available dollar, and then some, is being poured right back into research and development, and, critically, into scaling up manufacturing capacity to capture that huge future market opportunity. They're sacrificing profit today for growth tomorrow.
In the bottom line, the GAAP net income story obviously reflects that intense pressure, which is presumably why management focuses everyone's attention on the non-GAAP metrics.
Correct. It's standard practice for companies in this kind of investment phase. While Kratos did actually achieve GAAP net profitability in 2024, they reported $16.3 million in net income, which was a milestone. They have a history of GAAP net losses before that. Management, therefore, understandably heavily emphasizes adjusted EBITDA.
Right, earnings before interest, taxes, depreciation, and amortization adjusted for certain items.
Exactly. And adjusted EBITDA strips out key non-cash or non-operational expenses, most notably stock-based compensation, which is significant at Kratos. And when you look at adjusted EBITDA, it shows a much more stable and positive trend. It was estimated at $105.8 million for 2024. This supports the narrative that the underlying core business is healthy and generating cash, but the massive investments required for growth are masking that true underlying profitability, at least on a GAAP basis.
Okay, but the most significant financial weakness, the number that really screams tech startup, the clearest indicator of their current strategy, it has to be the persistent, intense consumption of cash, right? Let's talk about that negative free cash flow.
Yeah, that's the metric that gives traditional defense investors pause. The business model, right now, today, is intensely capital intensive. It is burning cash. It's consuming cash much faster than it generates it from operations. In the first quarter of 2025, their free cash flow was a negative number of $51.8 million.
Minus $52 million in cash out the door in just one quarter.
Yeah. And Q2 2025 saw that trend continue, resulting in another cash use of $31.1 million. This consistent, significant negative free cash flow just underscores that Kratos is still deep in the peak investment phase of its strategy. They are paying heavily right now for the transition from developing prototypes to building out industrial-scale production capacity.
And they're actually amplifying this cash consumption deliberately with really high capital expenditure guidance specifically targeting manufacturing expansion.
Exactly. They're not shying away from it. The company guided for elevated capital expenditures of between $70 million and $80 million for the full year 2024. And this money isn't, discretionary spending on fancy offices. It is aimed directly laser-focused on expanding manufacturing capacity for their high-growth areas, rockets, hypersonics components, and most importantly, enabling high-volume production of the unmanned systems like Valkyrie. This high capex is a necessary, painful precursor to achieving the economies of scale they absolutely need to make those big drone contracts profitable down the line. You have to spend money to make money, especially in manufacturing.
Okay, so putting it all together financially, strong revenue growth, but thin margins and negative cash flow due to heavy investment in future capacity. The entire investment thesis, the justification for that sky-high valuation, hinges completely on Kratos executing a near-perfect transition from this cash-burning R&D phase to high-volume, profitable production. It's all about the execution from here.
That's it, exactly. So what are the key proof points? What are the concrete milestones at the market that you should be monitoring closely over the next year or so to confirm that this crucial transition is actually succeeding?
Right. What tells us the strategy is working?
Well, the path to profitability and validating the investment thesis really depends on seeing clear progress in three key areas. The first, and arguably the most crucial one so far, relates to the flagship program, the XQ-58A Valkyrie.
And we know a massive milestone was hit there recently, right? Moving it out of the purely experimental realm.
Critically important milestone, yes. The U.S. Marine Corps officially designated the Valkyrie as a formal program of record, POR.
POR, Program of Record. Why is that specific designation so important in the world of defense contracting?
POR status is basically the magic word in defense procurement. It signifies a huge shift. It means the program is no longer dependent on uncertain, short-term experimental funding or R&D budgets, which can fluctuate wildly. Instead, it transitions into a formally funded long-term procurement program. It gets its own line item in the budget, it has a stable, secure, multi-year revenue stream attached to it. Getting POR status fundamentally de-risks the Valkyrie program from a financial and planning perspective. It's a huge vote of confidence from the customer.
Okay, so Valkyrie is now officially real in budget terms. Let's quickly recap why this specific drone is so valuable from a technical standpoint again.
Well, its performance characteristics are exceptional, especially considering its target price point. It's high subsonic, capable of speeds up to Mach 0.86. It has a very long operational range, around 3,000 nautical miles. It features an internal weapons bay for carrying munitions or sensors. And crucially, especially for naval or expeditionary operations, it has runway-independent launch capability. It doesn't need a long, prepared airfield.
And the financial magic is hitting that affordability target at scale.
That's the promise. Kratos is aiming for a target unit cost potentially below $2 million when they reach high production rates. $2 million for a reusable jet-powered combat drone is incredibly disruptive. They've also publicly stated that their current facilities have the immediate capacity to produce somewhere between 250 and 500 Valkyries per year. That signals to the market we're ready to scale up production now.
And that validation, that belief in the Valkyrie platform, it's extended beyond just the U.S. military, hasn't it? There's international interest, too, which significantly expands their potential market.
Yes, that's another major positive development. The partnership announced with Airbus to jointly develop a Valkyrie-based CCA platform specifically for the German Air Force. That's substantial.
Airbus, wow. That's a major aerospace player endorsing the Kratos platform.
It is. This joint effort targets having a system combat ready by 2029. It confirms that the Valkyrie isn't just a niche U.S. system. It's viewed as a viable, potentially leading platform on the global stage. It appeals directly to NATO allies and others who are also seeking affordable mass and cutting-edge autonomy for their own air forces. This potentially opens up a significant new European market for Kratos, which helps diversify their revenue base geographically and reduces reliance solely on the U.S. DoD budget cycle.
Okay, so Valkyrie hitting POR and gaining international traction is proof point number one. What else suggests Kratos' core competency, that rapid, affordable engineering model, is finding success across other areas? This is essential for de-risking the story beyond just Valkyrie, right?
That diversification is absolutely vital. It proves Kratos' model isn't just a one-trick pony, relying solely on winning the big CCA program lottery. And we have seen two massive recent contract wins that demonstrate this breadth. First, there's the program known as Project Poseidon.
Poseidon? What do we know about that? It sounds classified.
It likely is highly sensitive. Kratos announced they were selected as the prime contractor for this new defense program, and crucially, they stated the potential total value could be up to $750 million.
$750 million. That's transformational for a company of Kratos' size. That's nearly 70% of their entire 2024 annual revenue wrapped up in one single contract award potential.
It's massive. The actual formal contract award is expected sometime around the end of 2025, but being selected as the prime is the huge hurdle they've cleared. It validates their capability in potentially another entirely new domain.
Okay, Poseidon is huge. What's the second big win demonstrating diversification?
The second one is Project Anaconda. Here, Kratos was awarded Phase 1 with a potential ceiling value of $175 million for the sustainment and upgrade of the U.S. Navy's critical ANSPY-1 Aegis radar system.
Aegis. That's the backbone of the Navy's fleet air defense. That sounds like a very traditional defense contract, more like KGS's bread and butter.
Exactly. And that's why it's significant. It proves their ability to leverage the stability and expertise within the KGS segment to capture important long-term legacy sustainment contracts, while simultaneously using the U.S. segment to chase the high-growth, disruptive hardware opportunities. It shows the synergy of the dual business model working in practice. They can play both games.
Okay, so Valkyrie POR, Poseidon Prime selection, Anaconda sustainment win. The pieces seem to be falling into place. But the big internal challenge remains, doesn't it? The one thing Kratos absolutely must execute on flawlessly from here on out is actually delivering on these massive wins, the scaling hurdle.
That scaling hurdle is the primary internal risk factor. It's the ultimate test of management's capability now. Look, Kratos has proven pretty convincingly that they can innovate fast. They can design affordable systems. They can win the big contracts against incumbents. That part sounds validated. Now, they must transition successfully from being primarily a development and prototyping shop into a high-volume, efficient manufacturing and logistics giant. Almost overnight.
And that involves what?
Yeah.
Building factories, hiring thousands, managing complex supply chains.
All of the above. It involves absorbing that current margin pressure we talked about from the older fixed-price contracts, while simultaneously rapidly scaling up their manufacturing footprint. It means securing reliable, cost-effective supply chains for potentially thousands of components per year. It means implementing rigorous quality control for high-volume delivery. And it means significantly upgrading their program management capabilities to handle these massive, complex multi-year efforts like Poseidon and full-rate Valkyrie production without stumbling. Any significant failure to scale effectively major cost overruns, serious production delays, quality issues on these big new programs that would completely invalidate the entire investment thesis and likely crush the stock price. Execution is everything now.
Okay, now we absolutely have to address the massive tension sitting right at the heart of the Kratos story. We have this picture of enormous potential, strong market alignment, real execution on key programs like Valkyrie and Poseidon. But the current financial reality, the low profits, the negative cash flow, seems radically, almost absurdly disconnected from the price tag the market has assigned to this stock. Let's talk valuation.
Yeah, the valuation is the elephant, maybe the whole herd of elephants, in the room. It's unavoidable. Kratos trades at valuation multiples that are, frankly, entirely detached from its current very thin financial fundamentals. This is the clearest indication you can get. The market is not valuing Kratos like a traditional defense industrial company. It's treating them much more like a high-growth, potentially category-defining SaaS technology company, pricing in enormous future success.
Okay, give us the hard numbers again just to contextualize how extreme that disconnect really is.
All right, prepare yourself. These are based on estimates around mid-2025, but they tell the story. The forward price-to-earnings ratio, PE ratio, was sitting at approximately 149 times earnings. 149.
149 PE.
Their price-to-sales ratio, PS, which compares the stock price to annual revenue, was roughly 12.15 times. And if we look at enterprise value to EBITDA, which adjusts for debt and cash, it was somewhere around a staggering 237 times EBITDA.
237 times EBITDA. Okay, let's put that 149 PE in context again. If we look at the established defense giants, a Northrop Grumman typically trades around, 22 times PE? A Lockheed may be similar. And Textron's price-to-sales ratio you mentioned earlier was barely over 1 time sales. Kratos is trading at literally an order of magnitude higher valuation than its established, consistently profitable peers.
It's a completely different universe of valuation.
So what does the market need to believe about Kratos' future profitability just to make sense of today's stock price? What kind of scenario is baked in?
It requires a belief in, essentially, a near-perfect multi-year execution scenario. The market isn't just pricing in success on Valkyrie and Poseidon, it's pricing in that Kratos will achieve massive economies of scale in manufacturing incredibly quickly, and that this scale will allow them to transition their current 1.1% operating margin into something much closer to the typical defense industry average, maybe 10%, 12%, even 15% within the next, say, 3 to 5 years, and that they'll do this while sustaining rapid revenue growth. The current valuation leaves absolutely zero margin for error, no room for significant delays or cost overruns. It's priced for perfection.
Okay. We should also touch on their financial strategy for actually funding all this growth and bridging that cash flow gap. They did a big equity raise recently, didn't they?
Yes, that was a necessary move given the negative free cash flow and the high CapEx requirements for scaling up. Kratos needed capital flexibility.
Yeah.
They executed an equity offering in late 2025, raising approximately $483.8 million in net proceeds. Almost $500 million.
$1 billion. That's a significant chunk of change. A real war chest.
It absolutely is, and it's vital funding. It provides the cash cushion they need to fend the manufacturing scale-up, absorb near-term losses, and bridge that free cash flow hole until production ramps up and becomes profitable. But raising nearly $500 million in equity also sends a strong signal of management's high conviction that these massive orders are coming and coming soon, which, in turn, further amplifies the execution risk. They now have the financial resources. There are fewer excuses. Now they absolutely must deliver the operational results to justify both the fundraise and the valuation. The pressure is immense.
Speaking of management, let's quickly touch on leadership and incentives. CEO Eric DeMarco has been at the helm since 2003, providing stable leadership and consistently championing this disruptive narrative. How is the management team actually incentivized? Are their compensation packages aligned with pursuing this specific high-risk, high-growth strategy?
That's a key question for governance. And yes, the executive compensation structure appears deliberately engineered to promote exactly this growth path. It's heavily weighted towards performance-based incentives, but crucially, those incentives are tied primarily to multi-year adjusted EBITDA growth, not necessarily GAAP profitability or free cash flow in the short term.
So they get paid based on hitting those non-GAAP growth targets.
Predominantly, yes. This strongly incentivizes the leadership team to aggressively pursue these large, potentially cash-consuming in the near term, future-oriented programs that drive that adjusted EBITDA metric higher over a multi-year period. It aligns them with the growth story. However, this focus also creates a significant potential tension or disconnect with shareholder value if that growth doesn't eventually translate into strong GAAP profits and positive cash flow.
We can actually see that tension playing out when we look at the sheer size of the stock compensation expense relative to their actual profits, right?
Yeah, absolutely. It perfectly illustrates the point. The stock-based compensation expense alone, which is a real cost to shareholders through dilution, was reported as $29.8 million in 2024. That $29.8 million expense was 183%, nearly double the company's entire GAAP net income for that same year, $16.3 million.
Wow. So the cost of stock awards was almost twice the actual profit.
Exactly. It highlights the disconnect perfectly. Management is rewarded handsomely, primarily via stock, for achieving the non-GAAP growth narrative, even while the company is barely scraping by on GAAP profitability because of the massive investment expenditures required to achieve that growth. It's a delicate balance.
And ultimately, when you look at Kratos, perhaps their most valuable assets aren't even the factories or the drones themselves, but things you can't easily see on the balance sheet.
That's often the case with technology disruptors, isn't it? Their most valuable assets are frequently intangible. For Kratos, that includes the intellectual property developed over years of rapid, often self-funded development cycles. It includes the deep, entrenched DoD relationships built up over decades, particularly through the stable KGS segment. And critically, it includes the sheer scale of their potential future business, that staggering $13 billion bid and proposal pipeline they reported having lined up at the end of Q2 2025. That pipeline represents the future growth the market is betting on.
Okay, let's try to synthesize the overall risk profile here. We've established that the catastrophic risk, the risk of Kratos going bankrupt, seems relatively low. Why?
Right.
Because the stable, profitable KGS segment provides a pretty solid financial floor, right?
Correct. KGS acts as a backstop. It's unlikely the whole company disappears, barring some black swan event.
But the severe risk, the risk of a sharp, rapid, significant decline in the stock price, that risk seems very high.
That risk is high, precisely because of the extreme valuation we discussed. The stock is priced for near perfection, so any significant stumble could cause a major correction. The major internal risks that could trigger such a decline are primarily around execution failure, the inability to scale manufacturing quickly or efficiently enough, suffering debilitating cost overruns, or significant delays on the flagship Valkyrie or Project Poseidon programs. Quality control issues at volume would also be devastating. Externally, the primary risks center on competitive loss, particularly losing out on major chunks of the CCA program to a Tier 1 prime who successfully replicates the attritable model and then leverages their massive scale advantage. And of course, there's always significant budgetary uncertainty risk. Kratos is heavily dependent on the U.S. government budget and the appropriations process. Any major cuts or slowdowns in key programs like CCA could significantly impact their growth trajectory.
Okay, so let's try to wrap this all up. In summary, Kratos appears to be a genuinely innovative company. They seem perfectly positioned to capitalize on a massive generational shift in military doctrine towards affordability, mass, and autonomy. This positioning has been validated by achieving that critical program of record status for the Valkyrie and by securing enormous, potentially transformational new contract wins like Project Poseidon. The strategy seems to be working on the front end.
That's the bull case in a nutshell.
However, its current financial profile, particularly the low profitability and the persistently negative free cash flow, is radically fundamentally disconnected from its extremely high valuation. The entire investment case, the justification for that premium price, now hinges almost entirely on near-perfect execution in scaling up manufacturing and achieving rapid, significant margin expansion over the next few years.
That is the ultimate tension defining the company today. It's crystal clear. The bull case requires you to believe that Kratos is genuinely years ahead of the competition in a multi-billion-dollar, rapidly growing, attritable combat drone market, and that they can execute the fastest, most profitable manufacturing scale-up the defense industry has arguably ever seen. The bear case, conversely, rests almost entirely on that immense execution risk, coupled with the simple fact that the market seems to have already priced in near perfection, leaving little room for error.
So for the listener out there trying to track Kratos' progress, trying to see if they can actually pull off this incredible transition,
Yeah.
what are the, say, 3 critical metrics they absolutely must monitor closely over the next year or two to gauge success or failure? What should they be watching?
Okay, if you want to know if the strategy is truly working and starting to pay off financially, you absolutely need to monitor 3 things above all else. Number 1, you need clarity, real data on the actual margin profile of the production contracts for the Valkyrie and eventually Poseidon. We need to see concrete evidence that they can build hundreds or thousands of these platforms profitably, not just the initial prototypes at a loss or break even. What are the real unit economics at scale?
Okay, proof of profitable production at volume. What's number 2?
Number 2 is sequential, quarter-over-quarter improvement in the company's overall operating margins. This is the clearest, most immediate indicator that they are successfully achieving the necessary economies of scale on their manufacturing floor and potentially overcoming those earlier, lower-margin, fixed-price contracts. We need to see that 1.1% operating margin start ticking up consistently.
Makes sense. Consistent margin improvement.
Hmm.
And number 3, the ultimate signal of financial health for a company transitioning out of a high-growth cash burn phase.
Precisely. The third and perhaps the most crucial long-term indicator is the specific quarter in which the company achieves a sustained positive free cash flow inflection point. That is the magic moment. That's the point where they definitively move past the peak investment phase, where the operations start generating more cash than they consume, funding their own ongoing growth rather than relying on external debt or further dilutive equity offerings. Until that positive FCF inflection point is clearly achieved and sustained, Kratos remains, fundamentally, a high-growth, cash-consuming entity with a tremendous amount still left to prove to justify its current market valuation.
Okay, 3 key metrics: production margins, operating margin improvement, and that all-important free cash flow inflection. Got it. That brings us then to our final provocative thought for you, the listener, to consider as we wrap up this deep dive. We know Kratos is fundamentally trying to disrupt the established defense giants by being faster, more agile, and cheaper, essentially acting like a Silicon Valley startup dropped into the Pentagon's world. They excel at rapid R&D and prototyping. But what if the core competency required to succeed in the next phase of the modern defense industry shifts decisively? What if it moves away from just building sophisticated R&D prototypes, where Kratos clearly has an edge now, and shifts instead towards the immense challenge of managing complex, global, resilient supply chains and efficiently manufacturing thousands of systems quickly and reliably, essentially playing the high-volume industrial scale game? In that scenario, will Kratos' startup speed and disruptive culture remain a lasting competitive advantage? Or will they ultimately be forced to adopt the very scale, the operational bureaucracy, perhaps even the deep political capital requirements of the established primes they sought to disrupt, potentially eroding the very differentiation that made them unique and justified their explosive valuation in the first place?
It's the ultimate scaling dilemma, isn't it? Can the disruptor maintain its disruptive edge as it becomes, well, huge? That fundamental question, how they navigate that transition, will likely determine whether Kratos becomes the next generation's new defense giant, or perhaps just an extremely attractive, technologically advanced acquisition target for one of the current larger players looking to buy innovation instead of building it.
A fascinating question indeed. A fantastic deep dive into the strategy, the promise, and the paradox of Kratos defense. Thank you for walking us through that.
My pleasure. It's a compelling story to watch unfold.